My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I've been one of my friends. I'm just trying to make you some money in my job, not just to entertain, but to educate, teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Every day I hear about how expensive this market has gotten. Wherever I go, I'm constantly bombarded by people who believe stocks are doomed to collapse under their own weight. Yet somehow not a day goes by where I can't find some bargains, stocks that are simply too cheap and deserve to be higher, maybe much higher. And judging by these advances, I may not be alone. So let's take today, a session where the Dow gained 272 points, S&P climbed 0.60% to a record, NASDAQ advanced 0.78 to notch a new record as well. On the surface, I totally get these valuation worries. I get them. We just had one of the biggest flop IPOs at the end of last week, Robinhood, a deal for a borderline profitable company that broke its print price almost immediately. Next thing you know, the stock doubles. Literally doubles from its lows as throngs of young investors blasted this meme stock higher. Meme meaning it's love beyond all reason. And I mean all reason. Then we come in today, and insiders at Robinhood filed to sell 98 million shares. Sell. Less than a week, but 30 points higher since it came public. So, of course, the stock plunges 27.6% today. This is a true larger-than-life sign of overvaluation, at least according to the institutions, not individuals who control all big companies. That's what the institutions do. They control all except the two kings of meme, GameStop and AMC. I was going to yell boo, but I don't like to hurt the feelings of those memesters. They get such a kick out of me on Twitter. All right, I'll give the skeptics this, though. Given the run we've had in this market and the giddiness of many buyers, it makes sense to worry that stocks are overextended. But you know what? Do you mind if we just go deeper? Do you mind if we look beyond Robinhood for a second or the other meme stocks? Because they do not tell you what's really going on with this market. They're what people talk about. They are. I walk up and down past the exchange every day. That's all I want to talk about. But it's not all that matters. What does? All right, why don't I start with a familiar name? You've probably been there like 200 other million Americans in the last week. Let's start with Walmart. Despite Amazon's best efforts, Walmart's still the largest retailer on earth by sales. Until it caught an upgrade today, this Dow component was actually down for the year, even though it has excellent financials and sells for just 24 times earnings. That's basically a market multiple, meaning it gets the same valuation as the average stock in the S&P 500, yet I would say it's anything but average. I thought today's upgrade from Wells Fargo, just a piece of paper hits my desk, upgrade, hold to buy. I thought it made a ton of sense. It talked about how low-end consumers are flush with cash thanks to that generous child tax credit and, of course, the tight labor market. According to Wells, Walmart's got better earnings visibility than most of its peers. Plus, they can offer a better suite of services than most retailers, including new features from Walmart Plus, its attempt to compete with Amazon Prime. Psst, Walmart. Make it so that all drugs are the lowest price, and you'll get me to sign up. Now, let me give you the real clincher. The analyst points out to him, I'm going to quote this, because these were the magic words. Like, you remember Groucho Marx, an old show, which you obviously don't. A duck comes down and tells you the answer. Relative underperformance creates opportunity. Relative underperformance. See, remember, as of yesterday, the stock was down for the year. The analyst points out that Walmart has underperformed its peers since COVID got rolling, and so far this year, it trailed the S&P 500 by 18 percentage points. Compared to the likes of big winners like Target, Kroger, that underperformance is even more glaring, if not galling. In short, Wells says that you should buy Walmart because it's relatively cheap. With this push, just that, and nothing more, common sense. The stock rallied more than $2.65 today, almost 2%. More important, it broke out of a tight range. We own Walmart for the charitable trust, and our first instinct when I saw it go up today was, Lord, I'm back over even. Let me out of this thing. But you know what that did? That violated an old truism that I came up with probably 30 years ago. It's called the stuck-in-the-mud truism. And that means lots of investors have been viewing Walmart as being stuck in the mud. But now that it's extracted itself from that mud, they're going to buy the stock hand over fist, you see, because now they're saying, hold it, here it goes. I went in. And that's precisely what I think will happen here. You know what? The Walmart money train is leaving the station.
All aboard!
There are plenty of other big name stocks that have been left behind. I mean, take Uber. I mean, honestly, take Uber. This thing's down 15% for the year. Yet this morning, CEO Dara Khosrowshahi told us on Squawk Box, not on Squawk on the Street, just in case you're wondering, Squawk Box, that business is much better than expected for both ride-sharing and delivery. Those are the twins, okay? The only problem is that there aren't enough drivers. But he gave us some evidence, strong evidence, that the driver shortage will go away once the expanded unemployment benefits expire at the end of the summer. He gave us a bunch of cities where the benefits had already gone down, and those don't have shortage of drivers. Granted, Uber's not cheap on any traditional valuation metrics, but it's certainly undervalued versus where it's been trading and its peers. Okay, now let's just talk about stocks that are being given away. Let's talk about the chemical stocks. Now, these trade like we're headed for a truly nasty recession. We recently had LyondellBasell on the show. They're a diverse maker of all sorts of plastics. Really boring. But that's all right. Boring's okay. It's a chemical company, right? And this thing sells for 5 times this year's earnings, and it's got a 4.7% yield. 5 times 4. That's insane. Considering its prodigious cash flow and excellent management, it's hard to come up with any justification for why Lyondell should be this cheap. But money managers just say, forget it, Jim, it's peak earnings, which must be like, forget it, Jake, it's Chinatown. How about Trinzio? I know, the name itself says sell, right? But how about Trinzio? It's a plastics company we've praised in the past. Trades at less than 5 times earnings. I don't know. Forget it, Jake. It's the same story with the steel makers. Barring a worldwide calamity, not peak, but actually maybe an apocalypse, some of these valuations are absurdly low. Cleveland-Cliffs and Nucor sell at 4 and 5 times earnings. While Cleveland-Cliffs is a cobbled-together company with a not-so-good balance sheet, Nucor is the best-run steel maker on earth, one that's making fortunes right now with a terrific balance sheet and a healthy dividend. Yes, peak, it won't go up, but I don't think we're at peak. You might shy away from owning something like Robinhood, but the steels, even if the Delta variant crushes the global economy and cuts their earnings in half, the stocks would still be ridiculously cheap. It's the same deal with the homebuilders. I mean, Toll, Doug Yearley, he's a really good manager. Lennar, Stuart Miller, executive chairman, D.R. Horton, they're all clustered around 9 times earnings, except for KB Homes, which sells for less than 7 times earnings. These stocks are all pricing in a future with much higher mortgage rates and no customers, yet they don't reflect the relentless demand for new homes created by both COVID and plain old population growth. That's like people having children. If Fed Chief Jay Powell stays true to his word and lets the economy percolate rather than raising interest rates, these stocks can roar. Or let me put it another way. We're currently building 1.6 million new homes right now in this country, okay? We have demand for 2 million homes. 2 million. Finally, there are the automakers. These are hard. Stung by the chip shortage and rising raw costs, GM and Ford now traded at around 8 times earnings. I know that may be wildly overvalued if we're going to a recession or if it's peak Chinatown, but I don't think we're going into a recession. And it seems nuts to think that the Fed will create one right as we get another huge COVID outbreak. Forget it, Jim. No, I won't forget it. When it comes to the autos, pretty much every car they get on the lot sells, and sells at full price. There's no discounting out there. No. So look at it this way. 7 years ago, Ford traded at $18, okay? I know, I was at Dearborn. I was there when they were making the trucks. $18. Now Ford's at $13.71, okay? $18. Do you really think that no value was created in the last 7 years? Do you think that this company should be worth less now than it has a full line of electric vehicles on the way, a rapidly improving balance sheet, and a commitment to stop building cars in countries where it has a long history of losing money? When I think of the new Ford, I don't think of losses. I think of sold out, as in everything they make seems to be sold out. And Jim Farley is really changing that company. Bottom line, I know this take seems contrarian in a world where how long can this craziness last? But my most frequently asked question after can I get some Jim's None Better pickles? The answer, forget the craziness. Focus on the cheap stocks that have done nothing and sell for peanuts. They're a lot more plentiful than you might think, even more plentiful than a bushel and a peck of Jim's None Better sour dills.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.